Right. Recording started. Take it away.
Thank you, Sheila. For those attendees who've been waiting, thank you for your patience. We are recording this session to make it available for future posting on our website in the interest of transparency, to share with all interested resident, employees, businesses, and visitors of Torrance. My name is Adam Chaparyan. I'm the Torrance City Manager. We did this last year, the pension funding update, and so much has happened since. If you've been following CalPERS returns, they had the pension return is planned for 6.8%. However, CalPERS experienced a loss. And tonight with us, we have Dan Matsuchevich from GovInvest. He goes by Dan M. Thank you, Jessica, from Finance, for organizing. And with us, our Finance Director, Sheila Poisson. We ask that you please share this link with others. Excuse the siren behind me as we start this webinar. And after this meeting, like I said, the information will be posted online, and we appreciate you taking time from your busy schedules to join us. I'm going to turn this over to Sheila Poisson, Finance Director, who will then hand it over to Dan. Thank you, everyone. Thank you, Sheila.
Good afternoon, everyone. Sheila Poisson, the Finance Director here with the City of Torrance. As Mr. Chaparyan had mentioned, this is our second annual pension workshop. And before I kick it off to Dan is with GovInvest Inc. It's a company. They provide actuarial services and software solutions that project, analyze, and present pension plans and pension plan information. We've partnered with them to develop the models and the forecast that you'll be seeing in this presentation tonight. For those of you that are new to the topic of pensions, tonight we'll also be going over how they work, a little bit of CalPERS history, and the most recent CalPERS returns, how they impact Torrance specifically. Mentioned earlier that this is being recorded, so will be available on the city website. Everyone will also have an opportunity to ask questions, and we ask that you please save them for the end and type them into the chat box. So on the top of the screen, you should see a little word bubble that says chat, and that's where you can type in your questions. And Jess here will read them aloud at the end to allow us to respond. On behalf of Torrance, thank you all for being here. And at this time, I'll turn it over to Dan.
Thank you, Sheila, and good evening, everyone. Thank you for spending part of your evening with me. Pensions are an important but very dense topic. So I commend you for wading through into this deep topic. I typically will organize these workshops into really kind of 4 sections. We'll talk a little bit about pension basics, kind of the hurdles and considerations that all pension plans across the country are facing, some Torrance specific updates, and then some of the strategies that are employed or being deployed by staff currently. So part of the pension basics, I want to remind you all that this is the City of Torrance participates in a multi-employer pension plan. So it's administered by CalPERS, but the promised benefit is an obligation of the city. So think of CalPERS as the administrator, and the City of Torrance being the agency that made the promise to the employees, and therefore are obligated by this promise benefit. And once these promise benefits are made, the California Constitution has been pretty clear in their rulings that they cannot be changed retroactively. They can only be changed prospectively. So if you think about the length of pensions, even though pension reform has been implemented, it really does take decades for it to really wind through the active service life of employee and into retirement. So while reforms are in process, it does take decades to unfold. Exiting CalPERS it is possible, but it's really not a practical option. The way plans that are terminated are how they're valued, it ends up just being cost prohibitive. So I mentioned the Pension Reform Act of it was actually approved in 2012 by then Governor Brown, or introduced. It was effective January 1, 2013, and is called the Public Employee Pensions Reform Act, or otherwise known as PEPRA. Torrance has 3 CalPERS plans, one for their miscellaneous, their safety police, and then their safety fire plan. And the way the pension benefits work, so even though there's 3 plans, there are different tiers of benefits. So tier 1 would be the classic benefits that were enhanced in the late 90s, early 2000s. There was tier 2. So cities recognizing that if there were an opportunity to lower the promised benefit, they were able to do so prior to the enactment of PEPRA. And then finally, there's the tier 3 or PEPRA benefits within the miscellaneous plan. And the same is true when we look at the safety plan. There is a tier 1, a tier 2 that was implemented in 2010, and then the tier 3 plan. And one of the things that you will notice, not only has the benefit been reduced, the benefit formula from 3% at 50 to 2.7% at 55, you can see the final pay is computed over the final 36 months rather than the last 12. And that's a means to curtail any of the potential of intentional or even accidental pension spiking. So if somebody were to receive a larger than normal increase in their final year, that their compensation under the PEPRA plan is the average of the final 3 years, and that's why that is significant. And so, one more plan, which is the safety fire plan, very similar. So the pension benefit ratchets down, and again, we see the 36-month average pension compensation or pensionable compensation average of the last 3 years. So what do these formulas mean? If we take an example, 2% at 55, 2% is the benefit factor if the employee retires at age 55. And that benefit factor then is multiplied times the years of service times their pensionable pay. So in an example where an employee worked 30 years times the benefit factor of 2%, they would receive 60% of their pensionable compensation in the final year, or in the case of PEPRA, the final 3 years of their compensation would be averaged times the 2% factor. And so finally, if in the final year, if it was, or average was $100,000, their lifetime benefit would be $60,000 for the lifetime. Employees can retire earlier than the stated benefit formula. They can retire as early as 50 and receive a reduced benefit factor. So for example, if someone retires at age 54, the benefit factor is reduced to 1.9%, at age 53 down to 1.7%, 1.6%, and so on. So when we look at the transition from classic benefited employees to the PEPRA benefit, you can see by and large the city staff, the payroll is still predominantly the classic benefit, and as I mentioned, it does take decades for this transition to take place. But you can see over the next several years a prediction of a steep decline in the level of classic benefited payroll. So on the left axis, you see the payroll in millions. And on the right side, you see the percentage of PEPRA employees. So you could see by 2041, virtually 90% of the employees are predicted to transition to that lower PEPRA benefit. Of course, employees can, this prediction is based on their entry age and actuarial tables. Employees can make their own retirement decisions, whether it's something due to COVID or inflation, which may cause them to stay in the workforce either longer or in the case of the pandemic, we saw a lot of individuals retire earlier or chose to retire earlier. Now, pension costs are really made up of three components. The first part is normal cost, and normal cost is the cost of the promised benefit, assuming all actuarial assumptions were exactly met. And that's really a tall order, since actuaries are looking out, at least 30 years for the tenure of their active service, plus what might happen, how long they may live in retirement. And any of those deviations where actual experience deviated from the actuarial assumption would be recovered through this amortization of the unfunded liability. You've heard a lot probably about the unfunded liability. So once an unfunded liability is created because either an actuarial assumption has been changed or actual experience proves to be different than the assumption, an unfunded liability is created, and then that cost is recovered again through this second component of the cost, or the amortization of the unfunded liability. The two components together make the total employer contribution. Employees contribute to the plan, but right now we're really focusing on the employer obligation at the moment. When we look at some of those all-important assumptions, that they include economic assumptions, inflation, salary growth, a lot of demographic assumptions, how the average age of the workforce, when they will enter the workforce, when they may retire. A certain population may be expected to receive an industrial disability benefit in the case of certain classes of employees are more susceptible to being disabled on the job, and they would receive a reduced benefit in that case. But really, so you could see that you have the employer contributions, which we went over in the previous slide, that included the two components. We have the employee contributions and then investment income. And this is one of the really something that's kind of hard for people to wrap their heads around, is that investment income is already baked into the formula of the stated cost. So if investment income does not reach what was assumed, and the benefit levels are fixed, then the employer is responsible for picking up that difference. And we'll look on the next slide to over the course of somebody's active service life over a 30-year period, the normal contributions are these from both the employee and the employer really only accumulate to about a third of the promised benefit, and investment earnings are presumed to offset that promised benefit by a factor of roughly 2/3 of that promised benefit are assumed to be offset by investment earnings. So when investment earnings fall short, you can see when it's weighted 2/3 to 1/3, how much that impacts future employer costs. So we can see in this example, looking through the eyes of an individual employee, the expected expected benefit obligation is calculated by the retiree. It's discounted backwards for those presumed future contributions and investment earnings to a point of time, and that makes up what's considered the accrued liability for an individual employee at any given time. And that computation is done employee by employee for the entire workforce to determine what the expected accrued liability that is matched up against the cumulative employee contributions and investment earnings. And to the extent that there is any shortfall, that's what creates the unfunded accrued liability. And as I said, that is recovered over time as like a self-correcting mechanism through that amortization of the unfunded liability. So historically, you can see that the funded percentage of the CalPERS plan has really changed over time. And if you look back in the early or late 90s, early 2000s, you can see that the plan was more than 120% funded, and at a time almost 130% funded. And if you think about that time frame, this was kind of the height of the .com. The housing market was on fire, and there was an expectation that the good times would go on forever. And so two bills were introduced, SB 400 and AB 616, that paved the way for enhanced benefits. And the thought was if investment earnings were doing so well and the plans were overfunded, that investment earnings, or benefits could be enhanced at what was the banter was, well, at no cost to the city. And that's how a lot of the labor groups and just general population really talked about this, was that it potentially wouldn't cost employers any additional money, but that the good times didn't go on forever. And so while benefits were enhanced, and as we mentioned, they cannot be dialed back except prospectively, then what we saw is, as investment earnings went down, the funded percentage continued to go down for the plan, and the expected earnings assumptions really went down over time. And you can see, when I started in this area, the assumed earnings rate was as high as 8.75%. You could see it was reduced down to 8.25%, then 7.75%, all the way down to 7%. And now we know that the expected earnings assumption is 6.8%, where it stands today. When we look at earnings over time, it's they have several years where they've had very good returns. And what you see is the actual earnings that the plan had relative to the red line was where they assumed earnings would be. And you could see roughly half the time they were above the assumed earnings, and half the time they were below. However, we had a couple, large events, including the .com crash and the Great Recession, followed by really a 40-year slide of the treasuries. So if you think back in the late 80s, you could earn double digits returns on treasuries, but through August of 2020, the treasuries were down to, the 10-year treasury was down to 0.5%. So treasury, the lack of the ability to earn a return from the from U.S. treasuries really gave quite the dilemma for many pension plans. If roughly 40% of the portfolio is comprised of fixed income, and fixed income is just barely producing a return, well, how do you get back to 7% if 40% of the portfolio was earning less than 0.5%? And you can see over time that assumed discount rate was reduced all the way down to that 6.8%. So with inflation and the current dynamics of the market, the silver lining is that because of inflation, the Feds have been forced to put increased pressure on interest rates, and now the Treasury, the 10-year Treasury, even the 2-year Treasury closed above 4.5% today. So that, in the long run is going to provide some additional stability for pension plans, albeit it'll be painful in the short run as they are having to mark to market and reduce, take a market value hit on their fixed income holdings. It gets a little bit technical, but it will take some time before those higher yields have a positive total return for those pension plans. So let's talk about some of the hurdles. CalPERS once every 4 years actually goes through an experience study where they review measure up their assumptions relative to actual experience. So it's called an experience study. And during that last 4-year cycle, they reduced the discount rate by 0.2%. They lowered inflation assumptions, which sounds counterintuitive, but it really only impacts retiree COLAs, and those are usually capped between 2% and 3%, depending on what the city contracts for. In this case, 2%. So not all that impactful to the pension plans after all. And then, of course, they nudged up the wage growth assumption by about 5 basis points. And they've made some additional changes to other demographic assumptions, mostly mortality. But they may have changed disability assumptions, et cetera. They were relatively small and presumed to net to fairly insignificant number. The big news was in 2021 they earned a return of 21.3%, which when we look at the time, the assumed rate of return was 7%. So the experience gain, if they've already counted on that 7% return, then the experience gain, or the amount that the plan really benefited from that excess return, was 14.3%. And in an effort to reduce some of the risk and volatility in the pension system, back in 2015, then Chief Actuary Alan Milligan set up a risk mitigation policy that basically said, hey, we're going to take some of the excess return, so the amount earned above the assumed investment earnings rate. And remember, we said that excess return, or the experience gain, was 14.3%, which then triggered a 0.2% reduction in the assumed earnings rate. But that change in assumption is impactful because that is a forever assumption. It's assuming that CalPERS will earn essentially on average 0.2% less than the 7% assumption for the foreseeable future. So they're looking out 30, 60 years and 0.2% reduction. It adds up over time. So we know that for every collection of good years, there is usually some experience loss as well that bring us back to that average return, and that's exactly what we saw in at June 30th, 2022. This is not reflected in the valuation that the city has received. So we're projecting forward to say if the assumed if the investment rate of return is assumed to be 6.8%, when we take a look at the difference between assuming a 6.8% return and a minus return of 6.1%, that equates to an experience loss of 12.9%. And you may say, well, at least that experience loss was smaller than the experience gain that was earned in 2021, but you have to be careful about that because it's a smaller experience loss based on a larger number. So when we walk through this example, $10,000, have an experience gain of 14%, brings you up to $11,430. You then take a 12.9% experience loss, and you could see you end up below where you started in this very simple example. So let's see how this has impacted Torrance more specifically. So over time, you can see that the funded status, I'll kind of just cut to the chase. When you take the difference, the assets as a percentage of the accrued liability really get you to a funded percentage. And you can see that 69 in 2019, it was 69.9%. And this was a year that they felt slightly short of their assumed rate of return. In the years where they missed it by a larger margin, you can see that the funded status slipped slightly. And then in 2021, there were a large gain as well as some pension bonds or certificates of participation that were issued, or lease revenue bonds that brought the plan, the combination of the bonds that were issued and the return, put the plan into surplus, and the plan was slightly over almost 101% funded in 21. Unfortunately, as fate would have it, a 1-year return can change things dramatically, and we saw the funded status drop a little over 13% in that 1 year, and most of that really being the result. The big swing is in the impact on the market value of assets, dropped nearly $200 million as a result. And when we look at all the individual components that make up that change, that impact the net funding gain or loss, you can see that the investment gain, just as compared to the investment experience loss in 22, was slightly $30 million less than it was in 2022. And that is before considering the reduction to that discount rate or that long-term rate of return. So when I talked about that 0.2% reduction in the assumed earnings rate moving forward. That actually, for past service credit, reduced the funded status about $40 million by that minor 0.2% reduction in assumed earnings. The city actually had some demographic gains to the tune of $7 million, and those other assumption gains amounted to about a $2 million change. So you can see, as compared to other agencies in 2020, this is the bars up here represent all of CalPERS agencies. There were about 70.6%. And Torrance was right there with the average, about 69%, shot up to 100 and almost 1%, and then falling back down to 13%, but well above the average plan's funded status as it exists, as projected through June 30th of 22. And I say projected because that valuation, the June 30th, 22 valuation, won't come out until August of 23. So that is the projection. When we look at how that funded percentage will be repaid, as the amortization of that unfunded liability, as I mentioned, if you just make the normal payments, which the normal cost, and that amortization of the UAL, that UAL is brings you back self-corrected, assuming CalPERS, all other assumptions are met, would be fully funded in January of 2044. When we look at the costs moving forward, you can see that the normal cost is coming down relative to the change in benefits. So even in nominal dollars, it's actually coming down before it starts to increase at the assumed payroll growth of 2.8%. So it's coming down, but what we see is that the unfunded liability will be ratcheting up for that 1 year market loss. We hope that there will be a market rebound, if not this year or the next, the following, that will bring that unfunded liability back down. And so part of the city strategy was to issue lease revenue bonds, as they did in October of 20 at a true interest cost of 3.43%. So half the rate that is assumed to be earned in the pension system. So there's quite a bit of investment savings by doing so. And when we look at the total cost of not only the normal cost, the UAL payment, as well as the lease revenue bond debt service payment, you can see if CalPERS earns no less than 70 million, or than 6.8% per year, that the total payment would breach briefly over $70 million a year. This question has come up with many cities that did issue some sort of either lease revenue or pension obligation bond. Where would the city be had we not issued these lease or pension obligation bonds? So what I did is went back and just made the adjustments that occurred that were not known at the time the bonds were issued, and really made them to both sides of the equation to say how would the plan have fared had they not issued the lease revenue bonds. And you could see the funded status would now be, instead of being 87.5%, would have slipped down almost to 68%. And so The city is in a strong position, being funded at 87.5%. And we can see that the cost, there's quite a bit of savings on the front end. And we would hope, again, the way that investment earnings really are up one year and down the next. So as these investment earnings or this investment loss is phased in over that 5-year period of time, we would anticipate and hope that there would be a market rebound that would bring down some of these costs on the back end. But this city is still in a positive savings position as a result of issuing those bonds. The city has deployed a multi-pronged strategy to address their pension obligation through both the sales tax measure, SST, restructuring of the pension liability through the pension obligation bonds. The city is also contributing, recognizing that the investments are volatile from one year to the next. They're setting money into what's called a 115 trust, which is really a part of the IRS code, section 115, that allows cities to earn income that is tax free. But this trust essentially is a buffer against further adverse deviation or adverse experience in either actuarial assumptions or return. And this was all done to make sure that the pensions didn't squeeze out the costs to community programs. So the combination of these things really allows the city to continue to provide those high quality services to the community that the citizens have come to expect from the city of Torrance. That concludes my presentation. I'm happy to answer any questions for where we are today.
I have yet to receive any questions, so if anybody would like to submit them via the chat, be happy to read them off to Dan. I have one. What is the termination liability?
So the termination liability is really an acknowledgement that if a plan is not ongoing, that the plan administrator would invest the money much more conservatively. It would be an average of the 10-year and the 30-year treasury. And so if the plan is assumed to earn less than even the stated return of 6.8%, you could imagine if it was reduced down to the average of the 10-year and 30-year treasury, the unfunded liability would rise really astronomically and just make it unfeasible for almost any agency to pay off that liability. But it's more of a function of less assumed investment earnings, and that's why it's really deemed a termination liability, because termination assets are then reinvested in a much more conservative fashion.
Anybody have any other questions? If UAL was 100% funded in 2021, did we still have a termination liability?
Yes. So again, the presumption that a plan is 100% funded assumes that the plan would earn 6.8% for all years moving forward. That the actuaries, once a plan goes into termination status, then that liability the unfunded liability would be discounted at a rate of, maybe 2 or 3%. And then that the unfunded liability would, would at least probably double. That environment is changing with the treasury rates moving upward, but still would be astronomically high for virtually any city to buy their way out of the plan.
Dan, let me just add to that, just to give the group some context of what the numbers look like. CalPERS provides us with an annual valuation report every year, and at the end of these reports, it has what they calculate as the hypothetical termination liability. So they give you a dollar value of what your UAL for this plan would be at, let's say, 2.25%. So I just quickly opened up the valuation report for the police plan, one of the 3 plans that we have, but one of our larger ones. So the termination liability based on their valuation report at an assumed 2.25% is $1.2 billion. Which is why Dan mentions that it's essentially cost prohibitive for PERS members, like agencies to pull out.
Thank you, Sheila.
One other question, if the city, by way of restructuring its balance sheet and by way of generating new revenue streams, can pay off the UAL plus the street bond debt, what would the total be? 500 million approximately? Question.
So that would be the sum of the outstanding bonds at a particular point of time. And I don't have that number let's see.
Let's say 340 roughly.
Okay, so and the unfunded liability as of 22 was 230 million. So now we're talking about is that 570? So almost $500 million.
Any other questions? Nothing.
I don't see any. What I'm going to do too is I'll type my email address in the chat. So if anyone has any questions and wants to ask separately or at a later time, feel free to email me.
Thank you, Sheila and Dan. And this is Adam Chaparian. Sorry, my camera stopped working. And for mayor and council, should you have additional questions, we can always set up a separate in-depth conversation with Dan. Thank you all so much.
Thank you. Have a nice evening, everyone.
Thank you, Dan, and thank you everyone for joining. Again, these will be posted, this presentation and the slides will be posted on our website. Have a good night, everybody.
All right, thank you all.
Thank you.